I decided to get involved via syndications as an LP. And the first deal that I invested in happened to be a master meter deal in Texas where the owner spent, I think, $200,000 a year in electricity. And so I asked the group of GPs, what are you guys doing to eliminate or reduce that? And they said nothing, which I thought was fascinating. So that led me on this, just a learning curve of what is the multifamily world? How do people buy buildings? What are they doing from an energy perspective? And at the end of that sort of learning cycle, I realized that multifamily owners are sort of the least innovative when it comes to energy management. And so there's this huge opportunity to not only become owner of buildings, but also really lead an industry in energy management, which is just getting more and more important.
Welcome to CRE Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CRE Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investors' protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsuranceRisk.com. Today, my guest is Owen Barrett. Owen founded Rayven to decarbonize existing buildings at scale. Rayven is the world's first net zero real estate investment platform. Every property they buy is converted to true net zero, no offsets involved, by partnering with thousands of authentic retail impact investors. Owen, Rayven, and every single investor will decarbonize the world one apartment building at a time. And in just a minute, we're going to speak with Owen Barrett about impact investing, how you can invest and help lower the carbon footprint of commercial real estate. But first, a quick reminder, if you like our show, CRE Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Owen Barrett. Welcome to CRE Radio.
Yeah, thanks for having me.
Well, I'm looking forward to our conversation. Before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Yeah, I started off in finance and kind of got a knack for financial analysis. I enjoyed the analysis piece. I didn't enjoy the finance piece. So I went to grad school for environmental science. That launched me into a career as an energy manager for a Fortune 100 company. So it was my job to save the company money by saving them energy. Got a lot of exposure to really every different technology, clean technology that makes economic sense. And then I turned that into my first business, took that experience, started a company called Lumio, did the same thing for public school districts around California, ended up working with about 40 school districts and sold that company. And that's when I started getting involved in real estate investing. At the time, I did not know that sort of my background in energy management was going to meet this interest in real estate investing, but I decided to get involved via syndications as an LP. And the first deal that I invested in happened to be a master meter deal in Texas where the owner spent, I think, $200,000 a year in electricity. And so I asked the group of GPs, what are you guys doing to eliminate or reduce that? And they said nothing, which I thought was fascinating. So that led me on this, just a learning curve of what is the multifamily world. How do people buy buildings? What are they doing from an energy perspective? And at the end of that sort of learning cycle, I realized that multifamily owners are sort of the least innovative when it comes to energy management. And so there's this huge opportunity to not only become owner of buildings, but also really lead an industry in energy management, which is just getting more and more important.
Oh, that's fascinating. The just the notion that an expense, 200,000 was just like, no big deal.
Yeah, they actually
Um,
said we're not going to do anything. We just grow at 3% a year. I was like,
right,
man, that's
right.
not the right perspective.
Well, and I wonder how unique that is. I would. It sounds like you looked around and found that that's kind of more common. Uh, I know that the people I've talked with, it seems like more of just the bottom line NOI is that number you're trying to get to, and if you can get the rents up and maybe cut a few expenses, but it seems like, and I hope we get into it here with our conversation, it's just what's all involved in some of the work you're doing. But let me ask you this way. So Rayven, you founded that, or you are an investment firm, is that correct?
Yeah, it's a Regulation A offering, which is an exemption via the SEC that allows us to market to accredited and non-accredited investors. So it's a little bit different than how most syndications are put together. Those are usually Reg D.
Okay. And what, I guess I'm kind of curious, what is it that distinguishes the A from the D?
So Reg D, there's a 506C in which you can market to accredited investors. And then there's a 506B where you can accept investment from non-accredited investors, but you cannot market it. So there's sort of this conundrum of, well, we want to market and we want to go after non-accredited investors because we feel like there's a whole community of people out there that are pissed off about the lack of action against climate change, but they may not necessarily be accredited. It's hard to be an accredited investor. And so Regulation A is sort of this unique combination of both of them where we're allowed to market, I mean, not any way we want, but we have to do things within how the SEC tells us, but there's a lot of freedom with how we can market, and we can take investment from accredited and non-accredited investors. So it really opens up the universe to everybody.
Got it. And just to be clear, is the Reg A, is that from the Jobs Act? Is that,
It
is
is.
that,
Yeah.
okay.
So it's called,
Okay. So,
its nickname is a mini IPO.
okay. I sometimes I lose track of the different variety of options available, but I was thinking that did come about as a Jobs Act. So
Yeah.
got it. So all right. So the asset class you guys focus on, is it primarily multifamily?
Yeah. It's all, for the time being, it's all multifamily.
Okay. And is there a particular size of asset you guys look to buy?
Just for economies of scale from like a property management perspective, it's usually 100 units or higher. Occasionally we have a deal under contract that's two 52 unit properties that are close to each other. So we kind of view it as a, 104 unit deal. But that tends to be sort of our baseline.
Got it. And is there a particular territory you invest in?
There's not, so it's funny. We go after cash flowing assets, and we tend to find the highest cash flow in the Midwest, sort of North Dakota through Texas. That tends to be where electricity is cheapest, and there's sort of the worst solar regulations. The best solar regulations tend to be on the coast in liberal areas, but we don't invest there. So it's a little bit of a conundrum between where our solar model works the best versus where we have the best luck finding cash flowing assets. But at the end of the day, for us, it's a real estate deal first, and then it's a decarbonization opportunity second. So the fundamentals of the real estate are the most important thing. And then it has to be a good opportunity to decarbonize is sort of how we evaluate our opportunities.
Got it. You mentioned when we were talking about or just kind of your experience with as an LP, the separate water metering and that. Do you do things in addition to the solar, or is it primarily solar? Is that your primary act as far as I guess, energy neutral or improving the energy efficiency of the properties.
Yeah, no, we do a lot more than that. It's challenging to give sort of a blanket statement for what we do across every property because a lot of properties are different. Sometimes we'll replace windows, go from single pane to double pane. Sometimes we'll upgrade lights from incandescent or compact fluorescent to LED. There's a lot of efficiency work that goes into our properties, upgrading HVAC, potentially electrifying domestic hot water systems. But across the board, we install solar. So we do efficiency first to reduce the load on our building, and then we install solar. And we also really focus on solar because most people are familiar with solar. Like if I tell someone I'm installing VFDs, they're not going to have a clue what I'm talking about unless they come from the energy industry. If I tell someone I buy apartments and install solar on it, that usually clicks for most people because they're familiar with that technology.
Yeah, that makes sense. So on the properties that you're investing in and you're buying, is there any particular like a mix or a style? Is it multi-story building, single story? Is there an age that works best?
Yeah, so this is pretty exciting with our business model because this has changed recently. We always go after garden style properties, so 1 or 2 stories, because we need the maximum amount of roof space. It's a lot cheaper to install solar on the roof than it is in a parking lot. In certain markets, you can get additional value from covered parking, like markets where it's really hot, Phoenix, DFW, occasionally you can charge tenants for covered parking. And in those instances, it's actually better to install like covered parking solar. But most times it's more cost effective to install it on the roof. So that's why we look for garden style. When we started, we were looking for master meter deals. So think like a 200 unit apartment building and 1 electric meter, because that made it a lot easier for us to install solar. It was a single interconnection point. It was 1 set of plans to permit. But with master meter deals comes a lot of deferred maintenance because most of those properties are built in the late 60s, early 70s. So about probably 3 years ago, we started to try and figure out how can we take the same sort of solar value add model and apply it to sub-meter deals. So, 100 units and 100 electric meters. And at the time we couldn't do it. We could do the installation, but there was no way to manage the billing. So if you have 100 units, each with their own electric meter, you're actually installing 100 small solar systems, 1 system into each unit. That means every month you have to figure out how to bill your 100 tenants for the amount of electricity that they used from the solar that we installed and paid for. And up until recently, that was a manual process. So every month you had to go into what's called the inverter system and look at how much energy was produced. You had to turn that into a dollar amount. You had to bill your tenant. It's really burdensome process and it doesn't scale. So we actually just built a software product that now automates solar billing for us. So now we can implement our model on sub-metered properties, which is super exciting because we really want to get away from those older properties with a lot of deferred maintenance.
Yeah, no, I hear you. So I'm curious, I get the challenge with the multiple meters and that. Your software, are you still hooking directly to the individual systems, or have you been able to now have one solar system that then you're able to then, I guess, mathematically apply the credits back to the different residents' electrical bill?
So in a few states, there's something called virtual net metering. California is one of them. Some of the states, the New England states, have virtual net metering. And that allows you to do exactly what you just said. The utility lets you install 1 large solar system and sort of virtually allocate the benefits to all of your tenants. That would be nice if that existed across the country, but it doesn't. And it probably never will. We actually see sort of what's called net metering going the opposite direction. So it's going from more solar friendly to least solar friendly or less solar friendly. So with us focused on the Midwest, where there probably will never be virtual net metering, we still install 1 solar system per meter because that's the only way you can do it. It's a little bit more complicated from an installation perspective. There's a lot of what's called interconnections. So every time you install a solar system sort of into the utility infrastructure, that's an interconnection that requires a permit. So now we're permitting 100 systems, but they're all exactly the same. They're all 3 panels, 3 inverters, 1 interconnection point. So we just like replicate the permit set. And that's not a huge deal. It's more the billing that's been challenging, but that's now been solved with the software.
Interesting. No, I'm sure the permitting fees, they give that away. I'm sure they are happy to see you. So
Yeah, exactly.
yeah. So let me ask you. So the properties that you're buying, you mentioned you've worked on some of the older properties. Now you're looking for newer properties. Is there an age range that you find that is most agreeable?
No, it really works on everything. I think internally we've sort of set a benchmark of after 1990. That just tends, it's a little bit arbitrary, but we just want newer properties. We're okay with value add where you're, renovating the interiors and raising rents, but we don't want any huge like plumbing issues or big HVAC expenditures. So we just tend to set our sort of minimum year at 1990 and look for deals after that.
Yeah, no, I've been, older property is a lot of character and stuff, but oh my God, the capital improvement can eat you alive.
I mean, and it just takes one to really, ruin a year's of return, just something that is extremely hard to predict or impossible to predict.
Oh, I get it. So the projections that you guys provide for your potential investors and that, do you do some sort of a comparison as to the property with and without the energy saving upgrades that you guys do, or is that just part of the presentation?
So we used to do that when we were seeking capital from institutional investors. We would say, here's the deal as is. Here's the deal with sort of what we would call an optimal amount of energy upgrades. So up to a certain point, energy upgrades improve the returns. They help your IRR. But once you go past that inflection point and start going to net zero, which is sort of where all buildings need to get to if we're going to really have a chance against climate change, you start to chip away at your IRR. So, a regular deal may have a 15% IRR. You do some energy efficiency and some solar, you may get it to 17.5%. But then you go net zero and you may bring it down to like 12 to 13%. So we used to show that comparison. And what we found across the board is that every investor, whether they touted themselves as an impact investor or not, just wanted to maximize IRR. That's all they wanted to do. And so after talking to these institutional investors for 3 years and hearing the same thing coming out of all of their mouths, which was just a lack of authenticity, we pivoted and said, we don't want to work with family offices, private equity, institutional investors anymore. We want to go after retail investors because we think there's a huge amount of people that will be okay and excited about a 10% annual return, knowing that they're supporting net zero real estate. So now we don't show any comparison. We just say, if you invest in this deal, you will earn a 10% annual return, and you'll be, you'll be encouraging and allowing net zero real estate, which is where the whole industry needs to move to. And net zero real estate without offsets. Everybody's focused on offsets right now, and it's not the right attitude.
The offset thing, talk a little bit about that, what it is, I guess.
So a carbon offset is the equivalent of 1 metric ton of CO2. So the idea, when they started, it was a great idea, but like a lot of things, people have figured out how to take advantage of a good idea. The idea behind offsets is, for a lot of properties, you can only reduce your load so much on site via on-site energy efficiency and on-site renewables. Think of like an industrial plant, a manufacturing plant. There's just not enough surface area to install on-site solar to eliminate your load like 100% over the year to get net zero. So the group that invented the carbon offset was thinking, okay, if buildings implement energy efficiency to the best extent that they can, and then they implement renewable energy to the best extent that they can, and they still haven't hit net zero, then they can use offsets to eliminate the rest, what they can't eliminate because they just don't have the surface area. And that's a great approach. The problem is sort of twofold now. Companies are just using carbon offsets. So they're foregoing energy efficiency and renewable energy. And they're just saying it's a lot easier and cheaper for us to go net zero via offsets. And then the second part is the offset industry as a whole is immature and kind of lacks credibility. So there's been a lot of big offset programs that have gotten busted for putting forward sort of phony offsets. They were saying that they were doing some forestry project overseas. Turned out they weren't. So there's been a lot of that. So now when you see companies sort of pegging themselves as net zero, carbon neutral, whatever the buzzword is, on carbon offsets, if you dig into it a little bit more often than not, they're just kind of false promises.
Yep. The talk the talk, but don't walk the walk. Kind of thing. I get it.
Exactly.
Yeah.
But consumers are getting, they're getting more educated. It's going to take time, but there's companies now, Nestle is a good one, that just walked back their net zero commitment because consumers are starting to demand more. They're starting to demand actual action, not just buying the cheapest offsets you can find.
Right. No, it is frustrating. I think when you do look under the hood and look for the actual results, a lot of times like even in a lot of the laws that get passed, I mean, they'll have the title will be, helping, single mothers and children, and you find out that it's the details, it's making the, corporate, some sort of corporate welfare as opposed to the, what the title says. So.
Well, look at like the Inflation Reduction Act. I mean, I'm a huge advocate of that, but it's not going to do anything to inflation, or it's not going to do it fast enough. So it was just, inflation was a buzzword at the time, still is. So they passed a huge piece of legislation with that as part of the title.
Marketing, baby. That's
yeah, exactly.
That's one thing I know is that in America we know how to market. So all right, so let's talk a little bit about the systems. On a 100-unit property, you mentioned that the systems, they vary depending on what you're doing. But I'm assuming, based on everything you've talked about, between separate metering, the permits and all that kind of stuff, what kind of a cost would you budget for a 100-unit Midwest garden style apartment solar system? What would you expect your cost to run?
So
range?
If you were trying to go net zero on a 100-unit property, it's probably about $825,000.
Okay.
And then I would expect that you're probably going to save on a 100-unit. It's hard to say exactly, but somewhere in the neighborhood of like $50,000 to $100,000 to NOI.
Okay. So then you get your multiple on your cap that depending on what your cap rate is, what kind of how many years do you expect it to take to be a complete payback based on your projections?
So generally it really depends on what the cost of electricity is. In California, like I said, we don't invest in California, but the payback's like, if you take tax credits into account. So tax credits are really interesting. Normally we didn't take tax credits into account pre-Inflation Reduction Act, because as a real estate investor, you have a ton of depreciation. You're most likely doing a cost segregation study, so you have a lot of depreciation. So a tax credit on top of all that depreciation is kind of worthless. It doesn't really hold the same level of importance without the depreciation. But now, because of the Inflation Reduction Act, the tax credits are transferable. So we can actually sell our tax credit for cash. So now we do factor the tax credits into our economics because, even if we don't need them, we can sell them. And right now that market is pretty new. It hasn't really emerged. We're seeing the discount rate of like 20%. So if you have $1 million tax credit, you may be able to sell it for $800,000. But over the next year, we're going to see that market mature a ton, and it's probably going to be like a 5% discount rate. So you'll sell $1 million tax credit for $950,000. So in California, the payback's about probably 4 years. In Texas, sometimes it's 10, but we don't really evaluate it that way. We look at what's the cost of the project, what's the tax credit. That'll give us a net cost. In certain utilities like Texas, where Encore provides a lot of the electricity, there's an additional rebate on top. So that'll drive your net cost down even more. And then we take the NOI that project will generate and apply a cap rate to it. And if the value created exceeds the cost, then we deem it a good idea. Even if it equals the cost and it's a wash, I still think it's a good idea, because as a building owner, as a community owner, I feel like it's everyone's responsibility to do some level of good. That good doesn't have to be environmental. It can be social, but a lot of sponsors out there are kind of, they're talking about how they're improving the community and they're adding amenities. At the end of the day, they're just justifying rent bumps, which most tenants don't want. So I feel like it's our responsibility as an industry to have some level of positive impact in these acquisitions.
Yeah. No, I would guess that most tenants would be in agreement with you.
They don't care if you resurface the pool and bump their rent $250. They'd rather you not bump their rent.
Right. No, and I think there's also a level of, things are supposed to work. Why are you charging me for making them work, kind of thing.
Yeah.
I get it. You mentioned some of the tax credits. Are you able to finance these just on capital you're raising, or is this figured into some sort of a capital improvement budget, or are you getting any grants, or is there any other kind of options for financing the energy savings?
Yeah, we found that the best way to finance it, at least for us, is just to put it in the initial capital stack as a part of the CapEx. And so depending on what kind of debt we're using on our acquisition, some of that cost to solar is coming from equity and some of it's coming from debt. I wish there were better commercial financing options available specifically for multifamily, but it's just kind of a gap in the industry. Most lenders want to see, 3 years of a P&L to make sure that you're kind of financially sound. And they won't let you show P&L from a previous owner, which doesn't really make any sense, right? Like the operations of multifamily, you're buying them on the assumption that you're going to improve NOI. But so if I buy a property today, I have to wait 3 years to show 3 years of P&Ls under my ownership before most commercial lenders will even entertain a conversation with you. So there's some issues in the lending space around commercial solar, specifically for multifamily. And so because of that, we just put it in our capital stack from day one, and then we don't have to deal with any of these lender issues.
Problem solved. That's good.
Yeah.
What about the actual ownership of the system? I know I've talked with other firms that their single, their investment strategy was to own the solar system and put it on buildings and that, and then have it titled to them or something like that. Is this part of the building, and when you sell the building, the next owner will get the benefit of the system?
Yeah. Most times. So we bill our tenants back for electricity generated by solar. That's the only justification that we have to install solar in the first place. We have to be able to monetize the energy created. And in some states that requires that the equipment itself is owned by a different entity than the entity that owns the building, but it's all the same, managing members. So there's no control issues. The problem with those third party ownership structures, like the one that you mentioned, where they get rid of the upfront cost, which is great. But then there's this issue of what happens when someone wants to sell the property. Because if that next buyer doesn't agree to all of the language in the contract of the entity that owns the solar, it holds up the sale. And that's why you see a lot of specifically residential real estate agents don't like trying to list houses with solar that's owned by a third party, because it always holds up the sale. So we've strategically made a model where, whether it's the same entity owning the solar that owns the building, or a different entity that owns the solar, but really it's just like a subsidiary that owns the building, it doesn't hold up the sale in any instance. So we've done that kind of methodically. And I think that's a big part of the reason why solar really hasn't penetrated the multifamily market, because multifamily owners don't think it's worth getting into a third party ownership contract if there's any chance that it's going to hold up the sale and they need to exit.
Yeah, no, you're not looking for ways to gum up the works when you're trying to exit.
Yeah.
That's a little extra explanation to your investors. What about the power that you're generating? And I don't know what a 100-unit apartment building average, power usage is, but can you compare like a pre-solar versus a post-solar as far as the energy used from the grid for a the complex?
Yeah. So there's kind of two scenarios. There's the scenario where a utility has what's called net metering, and then there's a scenario where there is no net metering. And so net metering is the ability to export electrons back onto the grid, and you get compensated for those electrons. And the way that you get compensated usually is a credit starts to build up on your bill. So in the Northern Hemisphere, most solar systems overproduce in the summer. So you start to build up this credit on your bill in the summer. And then in the winter, the opposite is true. So then in the winter months, you kind of chip away at that credit. And if the system was designed correctly over a year, your bill should be about zero. So that's kind of how you net out your bill. In a non-net metering scenario, you don't get compensated for any electrons exported to the grid. So you can either design a system so that it does not export or exports very little. What we do is we still say there's net benefit to the grid for exporting electrons, even if we're not compensated. And so we still go net zero and just export some of the electrons to the grid. We're just not compensated for it. Because our perspective is we can't let utilities control whether or not we're going to make a net zero building. Utilities are inherently against solar because it takes away their revenue. So of course, they're going to try and do things to prohibit solar installations. So if we just play to the utilities rules, it doesn't really get society anywhere. So we've figured out a way to, raise money, pay our investors a return that they like, and do real net zero buildings anywhere in the country. We don't need net metering rules to do it. The economics are better, but we don't need them.
It's funny you mentioned that. I've got a couple of properties down in Florida, and I remember learning that it was like illegal in the Sunshine State to put solar on your roof. And I was like, wait. Solar is sun driven. You're the Sunshine State, and I think it wasn't until they came up with a way to make sure that they were, remain compensated or were in control of it. I mean, I think that's the case. I didn't follow it that closely because I don't have any.
Yeah, I mean, it has, some of it's a bit of a joke. In a lot of states, you can't build an off-grid house. Like the technology exists now with solar and storage. You still need to bring utilities to your property, even if you don't want them. And that to me is just an outdated model. I mean, the utilities could be on the other side of this, making money from solar, from EV chargers. Like they could figure out this transition is happening. How are we going to get ahead of it? And how are we going to make money from it? Instead, they're just doing what, a lot of big, old, dumb corporations do, which is they try and stop it or slow it as long as they can. But like you can't. No one will stop this transition. It's happening, and it's going to happen faster and faster as we, get closer to this net zero economy. So I think a lot of utilities are going to lose in that perspective.
Yeah. Well, I'm pro, kind of bucking the system a little bit, and especially if there's something good comes out of it, and sometimes it takes a little while to make the powers that I think that is true in a lot of things, is that anybody that's in power is going to do anything they can to protect themselves. I mean, I've seen it just in silly ways in different things where, an agency or a person or an industry is just, this is the way we do it, and it's like, well, that's kind of silly, but no, this is the way we do it. And, if you've got a stake in that, and that's your livelihood, and you've got, enough people that are affected by it, you can really slow the rate of change. But, it is the system we have.
It's a real short-term perspective though, right? I mean, like the ignorance of thinking that you can slow progress is just mind-boggling sometimes. I mean, there's a gazillion examples of corporations that have had that mentality. Polaroid comes to mind, and look what happened to them. So I think utilities are going to see similar fate unless they start understanding that this is an opportunity for them. And, and maybe they'll start encouraging some of this progress.
Well, it'd be nice, especially with all of the things that we're facing. Like I said, I'm an insurance broker, and there's clearly a consequence for the way that we've, way we've been behaving, or way we've been, acting and stuff, and anything I think we can do to, turn the corner or lessen the impact, I think is a good idea. But hey, let me ask you. So on, on these systems, is there a straight line depreciation? You mentioned, or cost seg. Do you guys, how long do these systems, how long do they last, and how long do you schedule for depreciation?
So we usually, you could do bonus depreciation 100% year one on solar. So we do that. But they generally last 25 to 30 years. I mean, there's a lot of instances where they're still performing past 30 years, but usually so there's like a couple key components to solar systems. One's the racking on the roof. The other's the inverter that, takes, I always mix this up, DC energy and converts it to AC, or AC to DC. And then the third is the module itself, the panel. And so the panels are usually warranted, like a production warranty, for 25 to 30 years. Inverters are usually 10 to 20 years. Racking, you don't really have to worry about. So we depreciate everything year one, and we expect these systems to last at least 25 years.
Got it. Hey, Owen, if we could, I'd like to shift gears for a second. By day, I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there are three strategies we typically consider. We first look to see if we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And when we cannot avoid nor minimize the risk, we look to see if there's a way we could transfer the risk. And that's what an insurance policy is, the risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be your clients, investors, the utilities, public policy, however you would like to identify what you consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance-related answer. And so if you're willing, I'd like to ask you, Owen Barrett, What is the biggest risk?
Yeah, I think it's easy. It's climate change. I think it's climate change for a number of reasons. From a utility perspective, I mean, look at the heat wave that we have going on now in the Southwest US. How are utilities going to keep up with all that demand, assuming that this is like the new normal? From an insurance perspective, we're seeing major insurers pull out of entire states because the climate risks are too high. State Farm just pulled out of California due to wildfires and Florida due to hurricane risks. So there's so many adverse effects of climate change that are going to just perpetuate through all different pieces of the economy. Agriculture is a huge one too. I mean, thinking about your food supply and how that's going to get affected. There's so many risks of climate change that it is just mind-boggling to me that it's not everybody's number one priority to do everything in their power, whether as an individual, a corporation, an institutional investor, to solve this as fast as possible, because I think we're moving entirely too slow.
I get it. Good stuff. Hey, Owen, where can the listeners go if they'd like to learn more or connect with you?
So for me personally, I'm on LinkedIn, Owen Barrett. That's really the only kind of social channel that I use personally. And then for the company Rayven, it's Rayven, and our handles are Join Rayven on everything, every major social platform.
Got it. Owen, I cannot say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Yeah, thanks for having me. It's fun.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.